Most investors think they know what ULTY pays, but almost nobody has actually run the numbers. So I took a full $525,000 and modeled the real income, month by month. And what I found shocked me, because the income is not what most people expect. Today I'm running a full simulation of what life would look like if you invested $525 into ULTY. No diversifying, no mixing funds, just ULTY on its own. You're going to see exactly how much income it produces, how stable or unstable the payouts are, and what the portfolio looks like, and whether a fund like ULTY could realistically support someone in retirement. I'm going to walk you through the actual spreadsheet, the income lines, and the long-term trajectory so you can see the truth for yourself before you ever put a single dollar into this strategy. So stay tuned. Welcome back to Simply Money. So today what I'm doing is I'm doing a hypothetical. Those who have watched the channel know that I show my portfolio, the actual income portion of it, where it's invested and how it's performing month over month. Today what I'm doing is I'm simulating what if I took everything and I went all in on ULTY. I know there's some people that have done that, and I'm going to stop right here and say this is not financial advice. This is for information and educational purposes only, and I do not recommend going all in on ULTY, or in fact any fund or any stock. That's my opinion, but I am showing this to show what it can do for those who are looking at ULTY and just to see what real numbers look like. So here we go. Here's the worksheet. We have it starting out on March 7th. That is the first time it paid weekly dividends. I know we could go back further when it was paying monthly dividends, but the focus on this fund now is the weekly payout. That's what gets a lot of the attention. That's why people like this fund. So I'm going with a starting date of March 7th, right when it started paying the weekly dividends. And we're going to see the share price and how it's gone down, and we're going to see the dividends and the amount those are paid. But we're simulating a $525,000 investment, which would get us 7,801 shares. Now, all of this has been adjusted for the recent 10-1 split, the reverse split that it did. Back on March, you might be seeing $6.73 for the share price. But it's actually adjusted just to make the sheet simple and easy to follow. Everything's been adjusted. It's just a matter of bookkeeping when it comes to those splits. So we're going to see what it's done, how it's performed. We're going to look at different scenarios that we normally look at: the full drip, the 50% drip, and the no drip. And we're going to also look at what would it take to maintain your balance of about $525,000. What percentage would we need to drip to reach that perfect balance where we're getting some income, but maintaining our portfolio balance? No growth, no decay, just an average balancing out. So let's start with what it looks like price-wise. As you can see, $67.30 when it started out. As we go down here, as of December 4th, we're looking at $40.06. We can also see that the dividend amount has been keeping parallel with the stock price, with the share price, was $1.03. Or back when you guys were following it and it was not split, it would have been 10 cents. So again, this is adjusted to the split. It was $1.03. And you can see that's come down, and over the recent months here of November, it's gone down to 84 cents, and now we're at the 58 cents. This is where a lot of people have been discouraged with this, but we're going to continue to look at this. I want you to hang on to the end. I think you'll be surprised that when you adjust the drip to the amount you want, it is very surprising. So stay tuned to the end on that one. Before we go any further, what are your thoughts? Where are you at with ULTY? We got a lot of news coming out. Mike Koo's going to be doing another interview with Simply Money. We have that coming out soon as well, talking about some of the changes that ULTY is bringing about. There's been a lot of noise with ULTY, a lot of positive things happening, but there's still a lot of negative noise around it. And so we're just trying to see what it can actually do. So let's look at with a dividend payment. This is a full drip, meaning for those that don't understand, full drip is you get your distribution, but you're just buying more of ULTY. You're just rolling that back in to build up your shares. And so that dividend payment, that distribution grows because you're growing the number of shares you have. So with the full drip, you can see the amount that you're getting paid each week. And again, this is on a $525,000 investment, you can see you're getting $8,000, $7,000 up here, $10,000 per week off of this. As we go down, we see those starting to increase as we're getting more and more shares. But then as that price has been declining in November, we see it coming back down. But I want us to look here. We're right around the $8,500, $8,400 mark week over week. These last 4 weeks have been pretty consistent, right in here, the $8,400 to $8,900. If we go back up our first 4 or 5 weeks, we're above that on every week. By reinvesting, you're definitely improving the amount that you're making per week. That brings us over to the value, because you've increased on this full drip, you've increased your shareholdings by 6,768. You've almost doubled how many shares you have, and your portfolio balance would have grown to $583,000, an increase of about $58,000. And that shows us here that we have a capital gain unrealized, because we're not selling anything at this point, of $58,000. So with full drip, you're definitely in the green in this scenario. Now, if we go to the 50% drip, you can see again how we do this is you're getting half of the distribution and you're reinvesting it. So you'll buy the number of shares that you can, and the other half is you using it for income. Here you can see that doesn't increase as fast and it doesn't decrease as fast, but we have this pretty steady income that's reinvesting. So we're buying more shares, and it comes down here where we're, averaging, looks like right around $4,000 to $4,500 each week. Now it's dropped down to about $3,200, $3,100 a week. With this, we've accumulated $160,000 in payment. We've been taking half of the distribution, which is $160,000. And we have that we can spend. We can use it for living expenses, whatever we're using it for. The other $160,000 has rolled into buying 2,873 more shares. But here's where you have to look at your value. When you do a 50% drip, yes, you've received $160,000, which is great, but could you maintain this? We're looking at this not as, what's your total return, which is important. We're also looking at it as, if you were to do this saying, I want to retire on this, where would you be at? Your portfolio balance would now be down to $427,000. In 7 months, that would be very scary, losing $100,000. Basically, 20% of your portfolio is being drawn down, and that's very scary if you're living and dependent on that, watching that balance. So a 50% drip, you're getting a nice chunk of income here, but you're not maintaining your portfolio balance, at least not in the short term. We'll see what happens is if the market starts recovering a little bit, if ULTY makes some changes that slows down that NAV, settles in on their yield, a lot of different things to look at to see what's going to happen. But we can see a 50% drip definitely doesn't maintain your value here, which lets us go to the zero drip, meaning you're getting this $8,000 this first payment on the 7,800 shares. You're not buying any more shares ever. You're just taking your distribution and you're running. You're taking it, you're living on it, you're using it. That's a nice healthy distribution, $8,000 a week. Most people don't need that to live on, but we're just showing the full power of, full drip versus zero drip and everything in between. As we go down, you can see that this distribution stays pretty consistent, anywhere from $6,000 to $7,000, $8,000, but it starts dropping here. And if you were depending on this, maybe you have a $250,000 portfolio, so you have half this amount, and watching that week to week get cut that much could be very difficult. Zero drip, because you're not adding shares and your NAV is eroding here from $67 down to $40, you're watching that, and now your distribution is $4,500 a week, which, looking at it and just the numbers right here, you're thinking, well, $4,500 a week, that's great. I can still live on that. And most people can. The problem is this is continuing to go down, as well as your portfolio balance. As that balance goes down, you're not getting more shares. It's not holding that up, and you're seeing this share price and distribution go down each week, and it'll continue to go down. It might bounce up for a moment, but it's going to continue to go down. And that brings your portfolio balance in just these 7-8 months, it brings it down to $312,000. And think about that. If you're dependent, you don't work, and you're saying, I'm going all in on this. And yeah, you're getting $277,000 in distributions. So, maybe you're living a great life and you're retired and enjoying that. But guess what? You cannot sustain that because you've already lost $212,000 in value. When you retired or stopped working with, $500,000, now you're down to $312,000. So it is not sustainable in that way. And that's where a lot of people get confused with these high yielding income portfolios. They are not meant for 100% distribution unless you're willing to let that value drop and you're using it to invest in something else. You're generating income for other assets. There's lots of different things you can do with it. But if you're going to try to maintain your portfolio balance, you have to do a significant amount of reinvestment. And that's what we're going to look at over here. What percentage do we need to reinvest to get this value to stay pretty even, to stay right around that $500,000? It might fluctuate a little bit week to week, month to month, but overall, long term, this is what we're looking at. What I did over here is I ran this simulation where we can change the drip amount. On this scenario right here, we're reinvesting 60%. This shows you the amount that would be reinvested. And over here, that obviously means you'd keep 40%. And this is the amount the payment would be each week on the 40%. And this is the number of shares you would have depending on this. And this is all dynamic, and we'll change this here in a minute. We can see that we're buying more shares. 60% of the distribution is going to buy more shares, and what our value is. And you can see here going down that it maintained pretty well. We actually got into the positive here for a while where we're actually ahead. Had nice little growth there for a little bit at this rate. But then as we get down here into November, that's when we started seeing that drop. And with the 60% drip, we're still down $70,000. Now, granted, we received $132,000 in distributions to use and spend, and we gained 3,560 shares, but our portfolio balance is still down $70,000. We're going to adjust this. All we got to do here is we're going to go to 85%, and we're going to see this changes to 15%. With that, this is the amount that you're reinvesting, the $6,829, and you're keeping 15%. Now, a lot of people will be like, what's the point of having such a high yield? Well, you can control this. It means that some weeks you could take out a little bit more, and other weeks you could take out a little bit less. Like when this was really high here at 605, 640, you're getting $1,500 a week. That's a nice little paycheck. But maybe because this has gone up a little bit, maybe this week you take 20%. And then when it goes down here, maybe you don't take as much. And again, that is up to you. And it's just showing the flexibility that these funds give you. But at 85%, you would be receiving this amount in this column and buying more shares. And you'd be receiving this amount for your income. This would be the amount you could live on. $1,100, $1,200, up here it was really nice, $1,600 a week. Since the beginning of this in March, when we began this scenario and this test, if you had done an 85% drip, you would have $304,000 reinvested. You would basically have maintained your balance. You'd be up about $6,000. Again, this is going to fluctuate week to week on this percentage, but we're just showing with the data we have at 85%, you would have maintained your balance. You would have increased your share numbers by about $5,400. And look at this, you would have had $53,000 of income. If, and again, I'm not recommending you do this, if you went all in on ULTY, you're looking at an 85% drip, maintaining your balance, and receiving $53,000 from March till December. So 9 months, you're looking at $53,000. Not too bad. So what do you think? What are your thoughts on this kind of drip analysis where you change the percentage? Some people, they're accumulating right now. They're just getting as many shares as they can. They're not needing the income now, so they're in this full 100% drip. If that was your scenario, let's say back here, and then you drop this, you say, okay, now I'm at 583, and I'm going to start changing what my drip is. Look at that. Instead of starting with 7,800 shares on how much income you're going to get, you'd be starting with 14,000 shares. You could take that and say, now you go to the 85%. Out of 85% of that, $8,400, you're going to get 15% of it to keep and then reinvest the rest and maintain this scenario that we showed where we're about break even. Our value doesn't change a whole lot. Again, you can see how it fluctuates. So this would be fluid. Maybe you go to 90%, maybe you go to 80%, and you keep it. So it's a matter of, as your portfolio is going up and down, how much you're keeping. Now, again, what are your thoughts? Leave them in the comments below. Do you want to see this with some other weekly pays? Is there another fund you want to see this type of comparison where we go in and say, what is that delicate balance of the drip? What percentage? Leave those down below. I appreciate your comments. I do appreciate you joining me, and we'll see you next time on Simply Money.